Zaheer Anwari from the Traders Cosmos. Can you hear me okay? Just double checking again for sound. Yeah, brilliant. Thank you, Administrator. Okay, excellent. Thank you so much. Good to see you guys. There's a few people on here today, so thank you all for taking time out to be on the webinar with me today. For trend traders, the foreign exchange market has been very, very quiet since January of this year. So, going back, beginning of the year, a good few months now, 6 months, the foreign exchange market has been very quiet and void of any trends. And so it's been quite frustrating, but that's part and parcel of trading, knowing when to trade and, allocate risk to the market, and then knowing when to stand aside and not take any trades. So effectively go into capital protection. It's a crucial element of trading. And we've covered aspects of that in the previous webinars. In the last sort of 2-3 weeks, we have seen breakouts. We have seen potentially the start of trends. And, I have got positions running, and we'll go through these sort of trending pairs that I have established themselves at the moment. Okay. So what we'll do, as always, there's a sort of structure to my webinars. We'll go through my screen setup, a quick revision of that, and we'll then go through the bulk of today's webinar, the main aspect of today's webinar, which is a general overview of the market and see which pairs are trending and which ones aren't. And then in that, we'll also incorporate past aspects of webinars, such as target levels, entry levels, possibly. Okay, so we'll cover certain tools and techniques, and then at the end of the presentation, we'll go through any questions that people have got. Of course, feel free. There is a chat box, so feel free to write the questions as and when they come to you. If I feel it's relevant at that moment, I'll answer it, and if not, I'll leave it till the end of the presentation. Okay, so any questions, just type them through. Okay, so let's get on with it. First and foremost, let's go through my screen setup. And what you can see in front of you is a typical chart setup for myself. The software I'm using is eSignals Advanced Get. Okay, so it is high-end software. Okay, it costs money. I pay monthly for the data. It's a serious bit of kit. On the left-hand side, you can see my watch list. Now, notice that my watch list starts at the Aussie dollar and goes all the way down to the South African rand, Japanese yen. So I have pretty much a good selection of pairs on my watch list. I don't limit myself to a handful of currencies or even a single currency or, just the majors. What you want is an extensive portfolio, because an extensive portfolio means that you'll have plenty of options throughout the year to trade. All right. If you just have a few pairs on your watch list, what then happens is that you end up chasing trades, and you end up taking trades at times of the year when there's no volatility, when there's no liquidity in the market, there's no momentum. And so you end up taking trades that you shouldn't have. Okay. So it's good to have a big portfolio because certain currencies trend at certain times of the year. All right. Now, if you aren't aware of my particular approach to the markets, I'm a trend trader. All right, so I'm looking for long-term positions that establish themselves from days to weeks to months. All right, I'm not a day trader. If you are from a day trading background and you're looking for a day trading strategy, then this is not what I'm about. I'm very much a long-term trend trader. My philosophy is based on the turtle traders. My mentor was trained by one of the turtle traders. I've been trained by my mentor. So it's that long-term philosophy that dates back to the 1970s, 1980s, Richard Dennis, William Eckhart. The strategies, the approach is still very much the same. Okay, nothing's changed. We don't need to reinvent the wheel. All right, so because of that, what you will notice that I've got the weekly time frame at the top and the daily time frame at the bottom. So this is a typical chart setup of mine. Now, the weekly time frame is where I look for overall market structure. So whether the market is in a trend or a consolidation, and the daily time frame is then when I go down to look for entry points, and most crucially, where I manage my stops. Okay, now you've heard me say this, repeatedly. People who are regular visitors to my website, to my webinars, people who see my tweets, people should know by now that I manage my stops on the daily time frame. I do not manage on the 1 hour, the 4 hour. You will get stopped out. Okay, you will get stopped out. Now, money in trading is made, as the expression goes, let your winning trades run. You've got to let your winning trades run. You don't want to get in and out too early because you'll just get frustrated and you won't make the money that you're looking for. So managing your stop on a lower time frame means extra noise, and your stop will be too tight and you will get stopped out. On a daily time frame, you eliminate all of that intraday noise and it's a much smoother ride. Okay, so the daily time frame is where I enter and also where I manage my stops. Okay, one question here from Manoj, which is, do you find that the spreads on some of these pairs are too great? Okay, it's a good question. When you're a trend trader and you're targeting thousands of pips, then the spread is really of no concern. Okay, I typically take about 100 trades a year. All right, so just as an example, I think last year I took, 70, 80 trades last year. I made almost 30,000 pips. And I made 102% return in foreign exchange. Okay, so when you're targeting thousands of pips, which trend traders do, spreads are of no concern. This is just part and parcel of trading. It's an overhead, it's a cost. I don't know, say for example, the South African rand, if that's got a spread of 60 pips, I'm happy to give the broker 60 pips because I know if it's in a good trend and with compounding that I can make a lot more compared to what I'm giving to the broker. So spreads generally are of no concern to me. Okay, so I hope that answers your question, Manoj. Okay, so let's start with the weekly time frame. Now, the weekly time frame, the first indicator that I'm going to load on is the 200 moving average. Okay, so the 200 moving average is an institutional moving average, as you guys are very much aware of. And on the weekly time frame, it acts as a major area of support and resistance. So you can see here that it's acted as a support level and we had a bounce to the upside. And so far, not an exact science, but it's acting as resistance as price is below. Okay, so the weekly 200 moving average acts as a major area of support and resistance. What this means is that if I get if I get a sell signal just above, I will ignore that sell signal and then take the next sell signal that appears below. Okay, and it's the same thing when price is below. If I had a buy signal just below the weekly 200 moving average, I would ignore that buy signal and then take the next buy signal above. Okay, so the weekly 200 moving average for me acts as a major area of support and resistance. I then also have these pink lines. Now, these pink lines basically represent the highs and the lows of previous years. Okay, so this is the high and this is the low of 2013. This is the high and the low of 2012, the high and the low 2011, so on and so forth. Now, for me, these act as major areas of support and resistance. Okay, guys, can you, I've just got a question from Charles Cole saying, why is my sound not working? Can you all hear me okay? Administrator, is my sound still working? Yeah? Yeah, okay, brilliant. Yeah, Charles, I'm not sure. He obviously can't hear me, so I can't help him with that. But as long as you guys can hear me, if someone can put a message through to Charles in the chat box to just let him know to figure it out. Thank you, Administrator. Okay, so the highs and lows of previous years. Now, again, it's another challenge that many traders face, which is if you go down to a lower time frame, you're going to find a lot of support and resistance levels. So then if you have a lot of support and resistance levels, which are the main support and resistance levels that you want to take into consideration? If you take too many into consideration, you're going to find areas where price is always going to reverse. I very much look at a macro picture. And for me, the highs and the lows of previous years are the major areas of support and resistance. So what I'm looking for in this case, you can see that price found an area of support at the end of 2013, beginning of 2014, and now price is heading up. So the first area of resistance will be this pink line low of 2012, then the weekly 200 moving average, and then the high of 2013. So you can see that I'm targeting large areas where price can trend. Okay, I hope that makes sense. And also, to keep things even simpler, I usually just look at the previous 2 years. So now that we're in 2014, 2013, and 2012, they are the areas of support and resistance that I take into consideration. Previous to that, I then start ignoring them. Also, within that, okay, great, Charles. Thank you. Welcome. Between these levels, the next thing that we want to be aware of are round numbers. So in this case, we had 0.8 back here acting as a support level. Then we've got 0.9. Now you can see that price found some kind of comfort around 0.9. So now what we're looking for is price to head towards 1, and then 1.1, and so on and so forth. So round numbers are very important as well. And I'm sure you guys are aware of this. Sometimes it's a little bit difficult for people to understand which round numbers are the main round numbers. For me, they tend to be around 1,000 pips. Okay, so let's picture it this way. Imagine price, I've said this before, give it again. Imagine price is below the floor of your room. The floor is acting as a support level, as a resistance level, and that's a round number. If it breaks the floor, resistance becomes support. Price will then head towards the ceiling. That's the next round number. What we want to be aware of is that between the floor and the ceiling, there aren't any pink lines. There isn't the weekly value index. Okay, if there's no pink line or weekly value index between round numbers, we can assume that round numbers become the next target level. So that's giving us a target of 1,000 pips. Okay, now the daily time frame. The first indicator that I'm going to load onto the daily time frame is the daily 200 moving average. Now, the daily 200 moving average is a little bit different to the weekly 200 moving average. The weekly 200 moving average acts as a major area of support and resistance. It's an institutional moving average. It's just an area of support and resistance. The daily 200 moving average is also an area of support and resistance. So you can see it's acted as resistance here, and it's now currently acting as a support level. Okay, so it acts as an area of support and resistance, but crucially, the daily 200 moving average also gives us a bias in price action. Okay, so what does that mean? What that means is when price is below, that is when we are in a bear market, and when price is above, that's when we're in a bull market. So if I actually compress this chart, what you can see is that going back to last year, we had a nice trend on the Aussie dollar, US dollar. And this is where we were shorting it. And we made a lot of money between, say, March, April, all the way through to August, September. So, we're looking at several months of trend. Then we had a correction. Now, this is where trend traders are not trading. Okay, now in hindsight, it looks like a nice trend and it's pulled back. But the point is that because we're below the daily 200 moving average, this is where you don't want to be trading. It's the simple moving average, okay? Once price bounces, this is when we start trading again. So what you can see is that when we traded the Aussie dollar, we traded it in periods. We traded it in this trend when it was below. Then we stood aside and then we traded it again. Okay, I hope this is trying to give you a picture of how trend traders trade when the trends are in play, stand aside when the odds are against you. Now, of course, in hindsight, it all looks very good, but at the time, we didn't know that. When we're below the daily 200 moving average, we want to be shorting. When we're above, we want to be going long. Now, this is not some philosophy that I've created myself. This is knowledge that dates back to the 1970s and beyond that. Okay, this is what trend traders of old have used. The turtle traders, Richard Dennis, they've all used this same philosophy. Okay, so this is nothing that I've just simply created. Okay, so let's have a look at what's going on the Aussie dollar. So if we start at the weekly time frame, we can see that price is quite clearly heading up. It is now above the figure 0.9, and it's trading above, as of this week, it's trading above this pivot level here. So ideally, what we'd like to see is price head towards this pink line, break this pink line, and head towards the weekly 200 moving average. If we look at the daily time frame, we can see the price is now heading up. We've had a big, strong bull move as of today, and it's now breaking, and what we ideally want to see is a close above this pivot level. If we get a close above this pivot level, this is a good sign of a continuation of the bull trend. Now, what a lot of people try to do is go short at tops and go long at bottoms. Okay, look, that's a very difficult and an inconsistent way of trading. What you want to be doing is going in the direction of the trend. So when highs are being broken, you want to be going in that direction. So the Aussie dollar should be on your watch list for opportunities to go long, especially as this pivot high has been taken out. What we want to see is price target the figure 1 and the weekly 200 moving average. If we get a break above this, then we should see price head towards this pink line high as well. If you decide to go long above the at any point, you want to make sure that you can at least eliminate your risk at some point before this pink line, or you want to wait for this pink line to be broken and then continue to go long, because this will act as an area of resistance. Okay, that's fine. Del, that's good. That's good. That's good. If you're in, you're in. For whatever strategy, whatever philosophy you're using, if you're already long, A, good, you're in the right direction. B, just be aware of how to manage your exits. Remember, in trading, entry points are very easy to find. Anyone can find an entry point. Breakouts, pullbacks, go down to a lower time frame, find an entry on a 5-minute chart. Anyone can find an entry point. The crucial aspect, the two most crucial aspects to trading is exit management and compounding. Okay, if you don't know how to exit from the trade, you'll get stopped out too early. And if you don't know how to compound, you'll never make the money that you want to make from trading. What most people tend to do is risk large on small moves because that's all they really know, and that's how they end up blowing an account. Whereas what smart money traders do is risk small on big trends and then compound into that trend as it develops. So a trend which moves 2,000 pips will accelerate profits to 5,000 pips based on multiple positions. Okay, this is the key to making money. This is the key to making money safely, consistently, and with very, very little stress and time involved day to day. Okay, so if you are long, good. Just make sure your exit management is on point. All right, let's. I'm just going to basically choose currencies which I think are worth looking at. Okay, so the first currency that I'm going to look at is the Euro Aussie Dollar. Okay, and now I am actually short on the Euro Aussie Dollar. I have a couple of positions running. So let's have a look. Let's start at the weekly time frame. Right, what we had was price. We could see that price was clearly in this bull trend. And then at the start of 2014, we had a tram tracks formation, so a reversal candlestick at a major resistance level. We had a fake breakout above, but since then the trend has headed back down. It is now trading below 1.50. So this is an area of which was support, is now resistance. And you can see that price broke below, retested, and is continued. That's a very natural movement to price. And now it's finding potentially a support level at this pink line high. But remember, I only take the previous 2 years into consideration. So I'm going to ignore this pink line high, and I'm going to target the figure 1.40 as my next support level. Ideally, I want 1.4 to be broken and price to head towards the weekly 200 moving average, and then beyond to the following support levels. The pink line, the question that's come through is, pink line, is a known downloadable indicator? The pink lines are basically a tool that comes with eSignal's Advanced Get. So if I just go into the back end, you'll see that it's a tool that comes with, it stands for Open High Low Close. It's a tool that comes with Advanced Get, and it allows you to choose the support and resistance levels that you want to display. So for example, if I wanted to display the monthly support and resistance levels, I could just choose the month, and you can see that it's displayed all the monthly support and resistance levels. I don't look at the monthly support and resistance levels. It's just too much for me. I look at the yearly support and resistance levels. And you can see that it's changed the pink lines. Okay, I hope that makes sense. Right, now, looking at the daily time frame, what we have is price below the daily 200 moving average. So that should immediately alert us to the fact that we are now in a bear market. I stood aside during this trend, during the weakness here, I stood aside and I waited for price to break, retest. Now notice it broke back above. The reason why it broke back above is because it came back to retest a round number. So the daily 200 moving average and the 1.5 figure was acting as a zone, a resistance zone of sorts. And we can see that price came back down, came back to retest, and it's now continued weakening. So I have a couple of positions running across the length of this trend. Now remember, price never moves in a straight line. It moves, it breathes, it moves, it breathes. Currently what we've got is a move, breather, move, breather. We've got possibly a triple top formation of sorts, and we can see that price is now heading back down as of today. We've got a reversal candlestick formation, an engulfing candle. Potentially what we'd like to see is price weaken further. If it breaks below this pivot, then we should see continuation of the bear trend, and that's when I'm going to compound. So I'll open up another position at a break of this pivot low, and I'd like to see price head towards 1.4. If I compress, you can see that there's plenty of space for price to move. We do, of course, have to be a little bit aware of the pink lines that stand in the way, but you can see that the next pink line is at 1.3, and we're currently at around 1.45. So you're looking at 1,500 pips. Okay, so there's plenty of space. This is what I mean by allowing trends to develop. Remember, a trend is a function of time. A trend is a function of time. If you eliminate time, you won't allow the trend to develop. It's a relationship that goes hand in hand. And it's a relationship that very, very few people really understand. Okay, let's have a look at the Euro New Zealand dollar. Now, the Aussie and the Kiwi, of course, due to geographical location, tend to do similar things. So if the Euro Aussie is weakening, the Euro New Zealand will weaken as well. Now, they don't do it at exactly the same price, but they tend to move in sort of similar fashion. Okay, so if we start at the weekly time frame, we can see we are below the weekly 200 moving average, but we've got the figure 1.50 and all of these pink lines acting as a strong support level. So we've got about 500 pips for price to move, but there is potential for price to bounce to the upside. So if we do take any shorting opportunities, then we do want to be risk-free. So we want to eliminate our risk before this level. So if price does bounce, we're not going to lose any money. If we go down to the daily time frame, we can see that we are below the daily 200 moving average. And we had a move down, we had a pullback, a double top formation, or head and shoulders, triple top, whatever you like, some kind of consolidation area. And since then, price has weakened further. It broke below the figure 1.6. It broke below this level. Now, after every big move, we go through a breather level. I do have a short position that is waiting to be triggered. So I do have a short position. My target is before the figure 1.5. Okay, so if we do get weakness before this pivot low, I will get triggered into the trade. So the Euro New Zealand dollar and the Euro Aussie dollar should both be on your watch list, as they are now in trend, but going through a current breather area. Okay, now the pound dollar. Okay, so the pound dollar, as we know, is, spoken about a lot, as is the euro dollar. We'll cover the euro dollar in a second. Now, the pound dollar, we've heard many times, the experts tell us that price will never break 1.7 for economic reasons or whatever reasons, import, export, I don't know. I mean, there's always some reason why price will never break 1.7. Ultimately, as a trader, technical analysis is all I need to know. I don't need to listen to the gurus on TV, Bloomberg. I don't need the Financial Times. When it comes to foreign exchange, technical analysis tells me all I need to know. Of course, when you're trading stocks, fundamentals do play a part, and that's a whole different approach. But when it comes to trading foreign exchange, fundamentals don't need to be involved into your trading. It will just cloud your trading and it makes it unnecessary. It's time consuming. Right, let's compress the data so that you can have a look at what's been going on the pound. Now, if we go back to 2007, you can see, thank you, George, you can see that we had a move down, again, round number, figure 2. We had a move down to the figure 2. We had an area of consolidation around the figure 2, so a round number, and then we had this huge crash in price, a very, very big move in price. So that is from 2008 to, you know, beginning of 2009. So only a few months we had a big crash in price. Now, of course, after a big crash in price, what's going to happen is price is going to go through an area of market correction. And even though there have been trends in this consolidation period, the fact is that this is just very much sideways, bouncing between the high of 1.7 as a round number and the low of 1.35. Thank you. Okay, right. So where did you last catch me? Did you hear me say double bottom at 1.5? Let's start there. Okay. So if we look at the okay, thank you. If you look at the double bottom, what we had was a double bottom at the figure 1.50. Now this, the second part of the double bottom, if we look at the date, is going back to the middle of 2013. Okay, so since then, the trend has been up. So if there is any direction that you have been wanting to trade this is long, because you can see that since the middle of the last year, the trend has quite clearly been up. It's broken through the daily 200 moving average, the weekly 200 moving average. So it gave, you know, suggested further strength to the upside, and it's broken through these pink lines quite comfortably. Now, what we had, if I just compress this again, was this pivot high acting as an area of resistance. And if you look at the bar today, the bar this week, you can see that this bar has actually broken above this pivot high. And because it's broken above that pivot high and the figure 1.7, this is suggesting that price is now in a trend. And we should see a continuation of the trend. If you look now, there are no pink lines. All the pink lines of concern are acting as support. The weekly 200 moving average is acting as support. So what should we be targeting? We should be targeting round numbers. So my first target is 1.8. That's my round number. Ideally 1.9. And actually, in reality, what I would like to see is price head towards the figure 2. So you're looking at almost 3,000 pips worth of target. Now, of course, it's not guaranteed. This is not, you know, I cannot say this will definitely happen, but we are playing on probabilities. We're looking at the odds and we're weighting the odds in our favor. And also remember, the future lies in the past. The future lies in the past. The price has been at that level before. Okay, price, yes, it does. Yeah, right. Price has been at that level before. So if price has been at that level before, there is potential for price to reach that level again. Regardless of what you hear on the news and what the gurus tell you, price analysis, technical analysis, price structure tells you everything you need to know. Trade the trend. Okay, it's very, very simple, guys. Now let's go down to the daily time frame. Now the daily time frame, you can see we're also above the daily 200 moving average. The daily 200 moving average gives me a bias in price action. So I'm above the daily 200 moving average. I'm above the weekly 200 moving average. I'm above the pink lines. I'm above the figure 1.70. I'm above the pivot high of 2009. I'm above all the major resistance levels, which are now acting as support. What does that mean? Price can only head up. A question has just come through, which is, how do I know when the trend has ended? Look, I don't know when the trend's going to end, but I don't want to predict when the trend is going to end. I will let price dictate. That's why I have a trailing stop loss. When you have a trailing stop loss and you allow that trailing stop loss to follow price action at a suitable level, it allows for pullbacks, and so it can then compound further. But also, at some point, the trend will reverse. My stop loss will have locked in 90% of my profit as the trend develops, 1995, and then I get stopped out. I get stopped out when I get stopped out. I'm not going to second guess. It's far easier to go with the trend than to dictate a reversal. Let's have a look at this trend. How many pullbacks were there in this trend? But the direction of the trend is up. So a lot of traders, what they're trying to do is go short at these levels, but it's short-lived. It's not how you're going to make money. Instead, you go in the direction of the trend, and at market correction, as it continues to break out, you open up a new position. It's called compounding. So the pound dollar, you should all be long on it. Of course, it's not guaranteed, but if there is one direction you want to be going, is long. Now, I do have other sets of indicators on here that help me. XTL. XTL tells me when the trend is green to go long, black to stand aside, and red to go short. Okay. So I've got green bars on XTL as well. And also I have another indicator which is quite useful, which is get stochastic. Now, most people use stochastic as an overbought, oversold indicator. So when it's overbought, to go short, and when it's oversold, to go long. I do not use stochastic in that way. What I have is this false bar, this black line. So what this black line means is that even though stochastic is overbought, ignore stochastic, do not go short, but go long in the direction of the trend. So all the confluences that I look for are all telling me that price is going to gain strength. Okay, there's a question that comes through. The market is getting ahead of itself. I'm not quite sure what that means, to be honest with you, Sharon, and I don't know where that sort of information has come from. Could you explain that? And what do you mean by that? And then probably I'll be able to give you something. Zaheer, if pound dollar is such a no-brainer long, then who is shorting it for us to buy it? Well, I mean, the reality is that most people in trading lose. The success rate in trading is only 95%, is only 5%. So, there are quite a lot of people who are shorting the pound dollar. And I had a conversation with someone only yesterday that he's short on the pound dollar and I'm long. So, for there to be winners, there have to be losers. Unfortunately, that's the name of the game. So, in which levels you set the black lines in stochastic? Okay, that's proprietary information there, George. So if you want to know more about my proprietary indicators, then please get in touch. But it's a proprietary indicator. Okay, it's just I'm giving you a little bit of information here. Okay, let's have a look at the Swiss franc. Someone has come through with the Swiss franc. Yep, sure. That was definitely one that I wanted to look at. Okay, so first and foremost, let's have a look at the trend. The trend is quite clearly down from here to here. So this is going back to 2010 to 2011. After every trend, we have a correction. And you can see that price has very much been in this consolidation area. So we've got price stuck between the weekly 200 moving average and the figure 0.9, and also this pink line acting as an area of support. So if I'm going to short this, what I want to see is price break below this pivot level here. So you're looking at about 0.8712. When price breaks below this, that's when I'm going to start looking to short this. And you can see that I can then target 0.8 and 0.7. So you're looking at, I don't know, almost 2,000 pips. Okay, so a little bit of patience on here, not something that I'm particularly interested in shorting at the moment. If we look at the daily time frame, we can see that price is very much messy, it's quite choppy, came back to retest the daily 200 moving average and the figure 0.9, so a resistance zone. Even though we had green XTL bars, remember price action is far more important. Okay, and then we had weakness, and now we're back in the range. So until price breaks below this pivot level, I'm not considering shorting the Swiss franc. Okay, it's one on the watch list. For me, it's not in the trend. This is more an area of consolidation. Remember, I'm a trend trader, guys. I'm sure most of you come from a day trading background. I don't really know. I've never had a personal conversation with you. But if you're day trading, you probably do not sort of see the trends that I see. Okay, and you're probably thinking, well, from here to here, that's 300 pips, 400 pips. Why don't you get there from there? Remember, I trade on probabilities. I'm only looking for the best setup. So while this is maturing, and until it gets to breakout and gives me a high probability setup, I'm not interested in trading this because I've got the pound dollar, which I can trade. I've got the euro Aussie dollar. I've got the pound Swedish Krona. I've got the New Zealand dollar, Japanese yen. So other currencies are in trend while this matures. So there is a time to be trading and there is a time to be standing aside. There's a misconception in trading, which is that to be a trader, you need to always be pulling trades. You don't. You trade when the trends are in play. You stand aside when not. Okay, so there is an art to it. Yeah, pound Swedish Krona, we'll have a look at that. From Mrs. C, 1 hour. Sorry, Mrs. C. Mrs. C. Mr. CC. I'm sorry, I don't know how to say your name. Could you please elaborate on that question? Swiss franc lower time frame. I don't trade lower time frames. This is what I'm trying to tell you. I don't go down to the 1 hour, the 4 hour. It doesn't make money. For me, it doesn't make money. Maybe it does for you. For me, it's inconsistent. It's stressful. It takes time. It's for me, it's not profitable. For me, the longer time frames are far more profitable. So I don't look at the 1 hour time frame when I'm actually looking to trade. Okay, right. Pound Swedish krona. Okay, so the pound Swedish krona, again, what we can see, if we go back to March of last year, the trend is very much up. Okay, the trend is very, very much up. And at the moment, it's facing a resistance level because that's the high of 2012. And you can see that we've got a little bit of struggle, reversal candlesticks forming. All this really means is indecision. You know, that's the other thing that people sort of get confused about is that when they see spinning tops, dojis, they're always assuming that it could be some kind of reversal. They're called indecision candles. This doesn't necessarily mean that we're going to see a reversal in price. What this means is that the bulls and the bears are kind of undecided on which direction they want to go in. The odds are more likely to go in the direction of the trend, but we've got this acting as resistance. So until this breaks above, I'm not going to be taking any more long opportunities. However, if you go down to the daily time frame, I have actually been trading this since about this level here. So when price broke above the figure 11, that's when I started going long. So I've got two positions running along the length of this trend. So from the figure 11 to 11.5. So I've got two positions and I'm in good profit. If you look at get stochastic, it's telling me to go long. All I'm waiting for now is for price to break through this pink line. If it doesn't, then it doesn't matter. I have a stop loss in play that's locked in my profit and I will bank my profit. And then when it starts trending again, I'll go in again. Okay, so the pound Swedish krona should be on your watch list. A break above the figure, this pink line high. Let me just open this up again. Then we should see price head towards the figure 12. Excuse me. Let's have a look at the New Zealand dollar Japanese yen. Okay, so the New Zealand dollar Japanese yen. Let's bring that up. Okay, so the New Zealand dollar Japanese yen, you can quite clearly see that price was up. It then found an area of resistance. Price came back down, double bottom, triple bottom around the figure 80. Price went back up, broke through the pink line high of last year. So now it's support. And what it's doing is just basically finding the figure 90 as an area of resistance. We go down to the daily time frame. We can see we're above the daily 200 moving average. Now, I actually entered into this trend around this area here. And so this is a good example of how sometimes you get triggered into a trend and price can then just go through a frustrating period of consolidation. I have quite a large a stop loss. My stop losses can be anywhere from 300 to 600 pips. And within the 300 to 600 pips, I'm not risking more than 2% of my account. But this is a good example of how when you get triggered into a trade, that sometimes it can go against you. But because we're above the daily 200 moving average, we're above the weekly 200 moving average, we're above this pink line, the odds are very much in the favor of the bulls. It's just that price doesn't always trend. It goes to correction periods. So what we're now looking for is price, if I just open up the weekly, is for price to actually move towards the figure 100. And you can see that price had reached that level approximately going back to 2007. So I'm targeting the figure 100 as my target level. And between here and here, I'm going to compound as the trend develops. Okay. Guys, I think there's literally about 5 minutes. Are there any other pairs that you would like me to look at? On weekly time frame, how many pips you're trailing stop loss? Okay, that's a good question. It really depends on how I compound. So my trailing stop loss could be, 300-400 pips away from price action. So it really depends on how I compound. Something that's quite useful, if we look at the pound Canadian dollar, this is something that I traded and I did eventually get stopped out. But something that you can use is something like the regression trend channel. Now, the regression trend channel is a very useful tool to use as a trailing stop loss. So the red line is my trailing stop loss. So as long as price doesn't break the red line, I'm happy. The minute it breaks the red line, I can then tighten my stop. So I move my stop to 10 or 20 pips below the red line, and then eventually price stops me out. So the red line is my trailing stop loss. And also what's good about it is that it gives me this value here, the Pearson's R value. And what you're looking for is a figure that's basically above 80, so above 0.80. So what that's telling you is how linear the trend is and how much of the trend is staying within the channel. So you can see that this, you're looking at 0.97, so effectively 97%. So, a good percentage of that trend, a very large percentage of that trend, most of that trend stayed in the channel. It never broke out. So this is where I entered around September and then eventually got stopped out earlier this year. And you can see this is a good example. I had 3 or 4, I think I had 4 positions running on here. And from around 1.64 to 1.84, which is roughly where I got stopped out. So you're looking at about 2,000 pips. But because I had 4 positions running, I leveraged my pips to about 5,000 pips. So if my initial position, let me just show you this. Now, if my initial position, you're welcome. So, I don't know how you guys use your entry, your stops, but I have a tool that basically works out my entry, my stop, and my target. This is not the exact tool because my tool, again, is proprietary, but, this is a similar sort of way of using my tool. So I've got my entry, my stop, and my target. When price hits target, I don't close my position. I let my winners run and I compound. I then use the regression trend channel as a trailing stop loss. What you can then see is how my first position, which had a 2% risk, has gone on to return me 2, 4, 6, 8, 10, 12%, just one position running along the trend. When I compound, you can see how that a single trend with 4 positions can then give you returns of over 20%. And this is between September and February, March. So you're looking at about 5 months, 4 or 5 months. So if I'm seeing returns of 20% plus on a single trend, the question then is how many trends do I need a year to have phenomenal returns? I've done that in 15 to 30 minutes a day because I'm using the daily and weekly time frame. And the returns are tax-free because in the UK, it's a spread betting account. It's less stressful. It's less time consuming. It's simple, small risk, large reward. This is a smart way of doing it. Day trading is only promoted by brokers. I'm usually quite direct about this. Brokers will encourage you to day trade because they want their spreads. They want their commissions. If you want to be a trader, you don't go to a broker to learn to trade. If you want to be a trader, learn from a trader. That's what I did. I found my mentors 8 years ago, and they taught me how to trade. My mentor learned from a trader who was one of the turtle traders. It's very logical. You want to be a pilot. You want to learn how to fly a plane. You're not going to go to a Formula One driver. Go to the person that has the skills and the knowledge that you want and learn from them. Okay, so the pound Canadian dollar, again, now that we're looking at this, you can see it's very much in an area of consolidation. What we're looking for is a break above this high. If we get a break above this high, then we should see a continuation of the bull trend. We're above the daily 200 moving average, so the odds are with the bulls. If we go to the weekly time frame, we're above the pink lines. We're above the weekly 200 moving average. If I compress price data, you can see that we've had highs of 2.5, 2.6 before. So ideally, I would like to see price head towards the figure 2 first, and then break the figure 2 and head upwards. Okay, remember we're playing on probability, so the odds are with the bulls and not with the bears. Trade the trend. Guys, the trend is your friend. Simple. Okay, I think I'm going to finish up. I'll quickly go through any questions. Thanks for sharing the profitable technique. May I know what is the expected win-loss ratio of your system? Yeah, guys, the other thing, it's a good question. Winners and losers don't mean anything. Do not focus on win-loss ratio. Focus on how large your winners are. Okay, so let me explain this. I can expose 20% of my account. Okay, so let me give you a scenario. Right now, I've exposed 20% of my account. So that means that each position I'm risking 1%. So I've opened 20 positions. Okay. In the worst case scenario, I'm going to lose 20% of my account. Now, I know with practice, this is very unlikely to happen if I'm only taking high probability setup. Now, over the next 3 months, out of that 20%, 10% don't make me any money, don't lose me any money. So they break even. I now have 10% left. Okay. Now, within that 10%, 5 of those are losing trades. So I've now lost 5%. The remaining 5% all return me 10% each over the next 3 months. Minus my 5%, I've made 45% profit. Now my success rate is only 5% if I show you how many winners I've had, but my profit is 45%. Okay, I hope this is starting to make sense. Focus on profit, not on winners. A trade log, most brokers will show you a trade log of 80% success rate, back tested something at 90%, signal services, Percentages don't mean anything. It's about how large your winners are, not how many winners you've got. Okay. Zaheer, do you use a spread betting account? Yes, I do. I use FXCM for my currencies, and I use IG Index for currencies and for stocks and everything else that I trade. The 200 is a simple moving average, Terry. You know, you can use exponential. I just tend to use simple. Okay. Okay. Excellent. Excellent. Thank you, Del Boy. Fantastic. That's great news. That's great news. That's great news. Okay, guys, I think that's it. I've run a little bit over time. So apologies, guys. If you want to get in touch with me, website, thetraderscosmos.com. Please contact me through the email system, the contact us. Okay, lots of information on here. I have a blog. I write for the Huffington Post, so please check out my articles. Last month, I was actually featured in the FX Trader magazine. Okay, so they invited me to write this article on basically trend trading. So please have a read of this article. Okay, women, please, I was invited to write this article on why there should be more women doing this properly. So please have a look at that. I'm very much active on Twitter. Sorry, I can't bring up my thing. Okay, but I'm very much active on Twitter. There it is. Please follow me at Zaheer Anwari, which is here at Zaheer Anwari. Now, also, people that I want you to be familiar with are my mentors. He's my mentor. He taught me everything that I know about foreign exchange, and Anne, who taught me everything that I know about stocks. Okay, now there really should be more people trading properly. Please follow Javed and Anne on Twitter. Okay, I think I'm going to leave it there. Thank you, guys. Thank you. Thank you. Yeah, I think it is recorded. It's in the archives. I've just been given a link by the administrator. Administrator, thank you. Sorry for going over by 4 minutes. I'm going to end it here. Have a great day, guys. Have a great end to the week and a great weekend. Okay, thank you. Take care. Bye-bye.